guys for being here.
Thanks for having us.
Thanks for having us.
Thank you.
All right, I'm just going to do quick intros for each of you. Sarah Foster, general partner in Oversubscribed Ventures, co-founder of Favorite Daughter, co-host of the world's first podcast, and executive producer of the hit Netflix series Nobody Wants This. Amanda Groves, general partner at Plus Capital, a venture firm which represents over 80 celebrities and athletes, including Sarah and her sister Erin. And Phil Schwarz, partner at Corazon Capital, advisor to Oversubscribed Ventures, and former CMO at Tinder and former head of growth at Match Group. Sarah, I'd like to start with you because you're the common thread here. Can you tell us a little bit about how you all work together?
That's a lot of pressure. No, it's interesting. Well, Amanda is at Plus Capital. They actually structured our Bumble deal. So in 2017, I won't make this a long story, my sister and I were asked by Whitney Wolfe Herd to be the heads of creative for Bumble, which was a departure from what we were doing in the entertainment business, but Whitney thinks outside the box, which is why she is where she is. So we helped her launch the Biz and BFF vertical of the app, and Amanda's company did that deal. This was in 2017 where you weren't seeing a lot of talent take these positions at tech companies. Now we see it a lot more.
Yeah.
So they were like, how do we actually structure this deal? Well, we figured it out, and it's become kind of like a blueprint,
Absolutely.
I think, right?
Yeah.
And then Phil, Phil, we met on Tinder. When he was working at Tinder, he came to us to do content and to try to appeal to women on Tinder. And then 10 years later, he just started bringing us deals, and I'm really talking long here for our 30 minutes. Let me land the plane here. And then when it came time to raise money, you know, we were angel investing, and the skin in the game was just not worth the time we were putting in. So we were like, let's do it with Phil. Let's utilize Corazon Capital, his firm out of Chicago. They're a consumer-focused fund. They're our back office. They're our due diligence. They do everything. I mean, we're really in a venture marriage. It's an interesting relationship, but we couldn't do it without him.
Yeah, and Phil, I'd love to hear from you. What drew you to work with Sarah and Erin?
Oh, that was easy. I mean, so like Sarah said, I met them, Sarah and her sister Erin, 10 years ago or so. I was CMO at Tinder at the time. We did some content together, and it was just very obvious to me they were special in a couple different ways, both through their content, but also just they were very smart and very intuitive. And so I sort of like registered that in the back of my head that at some point it would make a lot of sense to do something together. And when we stayed friends for, I don't know, 7, 8 years afterwards, they went on to do great things at Bumble. They co-founded Favorite Daughter. They launched an entire media business and a podcast and a show. And throughout all of that, they were getting deal flow. There was like deals coming in, and they would send them to me, and they would say, "What do you think?" And I was managing Corazon Capital at the time, and they said, "What do you think about this? What do you think about this?" And I think just seeing the way they thought about deals and how much was coming to them, it was obvious that they should have a fund, and that they could bring something that was unique in the space of venture capital that didn't really exist in the space of venture capital to the world. And so I was just lucky enough to be in a position to help them create it, and Corazon, our fund, was very supportive in doing that. But we were able to get it off the ground, and Oversubscribed Ventures was born, and it's a great thing to be a part of. But I think the decision to work with Sarah and Erin, I don't know, took 2 seconds in my head 10 years ago.
Stop it.
They are the most entrepreneurial of people, like not all talent should run their own venture funds or have their own venture funds. There are plenty of talent that get deal flow, but Sarah and Erin think bigger picture, It's like thinking about owning a piece of the upside that you're generating as opposed to just taking a fee. Like, they're perfect partners in that scenario.
Totally.
Definitely.
Well said.
Guys.
And you mentioned deal flow, which is where I was going to go next. I'd love to hear from you, Amanda. I'm sure you have no shortage of deal flow at Plus Capital with all the high-profile people you work with. Can you tell us a little bit about how you evaluate those opportunities?
Yeah, I mean, literally, just like any other venture firm would, right? Like, we spend a lot of time canvassing the landscape, developing sort of a more macro top-down view of where we want to allocate dollars. Largely, we're focused on consumer health, enterprise technology, and consumer product businesses, and are really thematic, and then develop theses around which managers within those sub-verticals are best in class, and those are the partners that we're going to. So we're talking to seed and Series A stage managers that really have sort of a point of differentiation and a great track record within a given category, and that's where we're finding 80% of the deal flow that ends up being actionable for us. Talent certainly attracts amazing deal flow too. Like, there are lots of companies, and not just consumer product companies, that want talent to be involved. And so that's a great source of volume, but I'd say lots of the actionable deal flow is being able to go to some of the top venture investors in the world and provide something different to the cap table on top of just capital, which is really sort of the value of audience and influence associated with talent.
Yeah, definitely.
Yeah.
And on the talent side, how do you decide when someone should be a client?
Oh, that's a good question.
It's a really good question, because
everyone's an investor, everyone's an entrepreneur, you know, but like, who actually wants to do the work?
and also has like staying power, right?
Yeah.
Because like there's a lot of maybe celebrity sort of gets a bad rap, or influencer gets a bad rap.
Well, it's changed.
Totally.
It used to be, and we talk about this all the time, not to interrupt you, but it's like, it used to be if a celebrity with a big following posted your product, you had a product, right? All of a sudden you're watching the Shopify go like this, and you're like, oh my God, we're gonna get acquired for $100 million, you know, but it doesn't work like that anymore. The consumer doesn't care. The person that moves the needle for us the most is a mom in Dallas with 45,000 followers.
Yeah.
She sells the most product for us.
It's amazing.
Yeah, it's amazing.
I mean, I think it's like the people that are driving conversion have incredibly large audiences that are deeply engaged, right? They're driving real conversion, but it's the clients that work best with us are entrepreneurial. They think about owning upside, and they're okay with exchanging cash for doing that, right? Because like the alternative is to take a short-term endorsement fee, but if you would rather take 250 grand today or take a couple points in Lyft, like you should be taking a couple points in Lyft or whatever the company is, and not all talent think long-term about that. And so being able to get their hands dirty, like it's not just putting a sexy name on the cap table, like writing your name in a press release and hoping that it moves the needle for the company. It's really about showing up for events or creating content, being
Talent
really
needs to rewire a little bit, because I think that we are, not putting myself in that category, but you are sort of, you're used to the big check, just that one time only big check, and you have to sort of reprogram and go, wait a minute, you know, like.
Yeah, I think the big open white space, which I think Oversubscribed is filling and Plus is filling, is talent that has actual consumer sort of credibility, but a willingness and like an excitement about rolling up their sleeves and like actually doing things. Because, you know, for a long time you have talent involved, and maybe if you got a social post, you were happy, like Sarah said, and maybe that moved the needle for you, but those days are long gone.
Yeah.
So you need authenticity, and you need like repeat behavior, and that's just hard to find in the pool of talent, and I think, you know, that's what those are the things that.
And on the talent side, you can't be, you know, right when we exited Mirror, which Phil actually brought us, it was too late stage for him, Tonal came to us for a good amount of money, and we were like, oh God, like how do we not do this?
Yeah.
But we were like, if we do this, then we automatically just lose half of our audience. We lose our credibility. If 1 minute we're going, buy this mirror, this is how you should work out. And then, you know, 2 months later, we're like, no, actually, this is how you should work out.
So you mentioned a mom in Dallas that's been really impactful in favorite daughter sales. For people in the audience, how do they find their mom in Dallas? How do they like sift through all the influencers?
Oh God, that's a tough one. Amanda, will you take that?
I wish I could. I mean, honestly, most of the talent that we work with are household names, right? Like they're driving high-level brand awareness, but I think some of the best marketing strategies are leverage somebody like a Matthew McConaughey or a Scarlett Johansson or somebody like that who has big, like wide-scale brand recognition, and then leverage an audience of micro-influencers below them that can cast off of them a little bit and then drive the conversion on smaller audiences.
Also, the consumer is sick and tired of the filters. I'm not saying I don't use filters, but the consumer is tired of it. You know, our Dallas mom uses no filters. She is a relatable size. You know, she's just, her audience, I think, just really trusts her. The consumer now is watching influencers and talent going, but is that actually your body? Is that actually your face? We don't know anymore, because with AI and with all the things and the tools, it's hard to tell. The consumer's never been so smart and has never had so much at her disposal or his disposal. It's a very oversaturated market, clothing, beauty, you know, it's hard. So I hate I hate the word. It's such an overused word, but it is one of the most important words when it comes to driving product.
Well, and how like talent can engage with portfolio companies. Like if they don't care about the underlying product or mission or service, like it's very obvious, it's very transparent that they're just showing up to an event or writing a white paper for something that they're going to earn some compensation in. Like you really want them to care about an elder living facility or democratizing access to mental health care or a skincare product. Like authenticity really matters in order for this strategy to work.
Yeah, definitely. Sarah, you've talked a lot about your ecosystem between all the different projects that you work on. Can you tell us a little bit about how you use that and leverage it for the companies you work with?
So I really believe that they all feed each other. I believe that one doesn't exist without the other, really. I mean, it's the same girl. It's the same girl that is listening to our podcast, that is buying our clothes, that is buying the products that we invest in, the consumer products that we invest in, that we tell her about, and then is watching our TV shows. It's the same girl. And we didn't sit, with like, I made this joke at the TechCrunch conference, we didn't sit with like a Ouija board going like, ooh, we're gonna have this ecosystem. I mean, it really was just born out of us, jumping outside of our comfort zone and saying yes. I mean, when we took the job at Bumble, everybody told us we were crazy. When we went into a joint venture with Centric Brands for Favorite Daughter, everyone told us we were crazy. They were like, Sarah, you should not be giving away 50% of your equity before you even have a conversation. You should raise a little bit of money, own 80% of the business, give away 20%. Everybody told us we were crazy to do a joint venture, but we're in a 50-50 joint venture. And I always say it's so much more important to know what you don't know than what you do know. And I don't want to deal with supply chain. I don't want to be going to Mexico and Morocco and all Turkey and all over the place dealing with manufacturers. I don't know how to do that. I want to go do the things I know how to do, and our partners are facilitating everything, and that is why we were profitable year 2.
Yeah.
Because it was a good decision. All of my best decisions were who I've surrounded myself with. You guys.
Well, it's very nice of you to say. I would highlight something which is, and I think a commonality between all the funds represented here is that Sarah highlights the ecosystem they have. It's a very different, they come from a totally different place in the world of venture. There are no general partners at venture funds that have a hit show on Netflix and a hit consumer-facing podcast and a clothing brand that they co-founded. I mean, it's just a totally unique set of skills. And what that all comes back to is value add to portfolio into the world of venture. Because the world of passive investing in venture at the early stage is a very tough world right now. I think we're all here looking at it through a lens of how much value can we possibly inject into the companies in which we invest. And we all do that a little bit differently. We on the core zone side, we come from the operating side, and we know a bunch of things about how to build companies. And Plus has an entire model built around injecting value into companies. And Oversubscribed, I just talked about the differentiation, but it is all, the common thread is value creation in early stage and giving your companies an unfair advantage.
And coming up with organic ways to lower customer acquisition costs.
Totally.
100%.
Totally.
Because that's just a conversation that I think everyone is having, is how to acquire a customer for cheaper. And when Erin and I are on the cap table and when Amanda does deals with her talent, we're lowering that cost by doing the things that we do.
Yeah,
Totally.
But ultimately, the game of investing in venture is all about access, right? And we all, I think, have differentiated access by virtue of the value that we add to portfolio companies, and it's repeatable, and you can measure the ROI associated with it. And I think that venture has come to a place where there's a reversion to specialists, and the specialist managers, whether it's healthcare or consumer or SaaS or fintech or whatever, operators want to work with specialists for whatever their problem or opportunity is, and the same way that they want to work with us when they have questions around customer acquisition or business development or brand awareness. We all know how to do
We're trying to figure out how to feel relevant. All these founders, they're just how do we get to relevancy quicker? Because it's so hard, as we discussed. There's just so many fantastic companies and founders out there right now.
Yeah. And but an equivalent amount of noise in the market. So for a founder to break out, like you said, is just so much harder than it was even 5 years ago. And so you need unfair advantages.
Yeah, so what kind of metrics do you use when founders are coming your way to evaluate whether they're of the moment, longer term?
It depends on the category in which the company is operating. A lot of what we do is consumer or consumer touching. And by the way, consumer I should define. We think about very broadly. We don't think about it as CPG only. Sometimes people kind of interpret it that way, but it's really consumer touching technology and products and services that wrap around the consumer. anyway, when we look at consumer, we look at how much lifetime value can a consumer company build with its audience over the course of time. Like, what is the quantum of that? Is it $100? Is it $1,000? Is it $10,000? We look at how much it might cost them to acquire a customer and what impact we can have on that cost of acquisition. And the ratio of those two things, and then we look, of course, like margins in the industry and what type of profitability they can generate. And then we look at fund return potential. This is where a lot of things, particularly in the world of CPG, fall down, which is we're totally open to invest in CPG. Finding fund returning potential in CPG today is incredibly hard, incredibly hard. Like you have to get in at the right price. You have to, the right valuation, I should say, like on a deal. You have to actually create some value and give them an unfair advantage, because if they're not growing fast, they're not profitable, they're not going to generate
right, and
a
who
real
are the legitimate buyers? Like, how many clean deodorants are Procter & Gamble going to buy, right? I mean, you have
Totally.
to look at that.
Totally.
Yeah.
But we're not allergic to CPG, as a lot of funds are. We're not allergic to it. We still believe. I mean, what is it? There's real data around this. 75% of dollars are spent.
Yeah, consumer spend is, 70, 68%, 70% of the US economy.
And venture is barely doing it, right? We're one of the few. People are like, you're still doing CPG? We're like, yeah,
Yeah.
we are.
Well, particularly if you can enter at a point where companies achieve product market fit,
Yeah.
where the valuation is low relative to the overall pref stack, right? Like you can be really thoughtful about your downside protection. But if you exit that company for $300, $400, $500 million, those are totally viable. Like there's the KDPs, the Mars, like a bunch of big conglomerates that are very acquisitive in the space right now. It's all about, to your point, it's like entry price is what matters here. And you can still have really great outcomes in consumer. It's probably only a third of our portfolio at this point, but there are still great opportunities. You have to be really choosy.
Yeah.
And we are very picky, as I'm sure you are too. We are very picky on entry price, and we are very kind of thoughtful on capital efficiency of the business going forward, so that they don't have to raise a bunch of money to get to an outcome that ends up being a highly diluted outcome.
We actually have something different at our fund too, at Oversubscribed, which is, you have to, when raising money, you have to figure out what is separating you from everybody else. Why should, as first-time fund managers, anyone give us $1? And one thing that we structured sort of going into it was advisory shares, which is a huge, it's just an advantage, right? When you, as an investor, where you want to put your money in the consumer space. It's not a mandate that we get a one-to-one deal, but we prefer it. And we've gotten it, a lot of times, and so that sort of differentiates. When you're talent going to raise money, you got to find why you.
Yeah.
Why should you trust us with your money?
But to be fair, you're getting advisory shares for doing real things, right?
Yeah, we do real
I think
things,
that's the point of differentiation with the Fosters and all of our clients. Like we think about advisory shares tied to really specific deliverables. So value is only being exchanged when it's being created. So show up to this event, create this content, like do a really interesting business development opportunity and show up to a conference. That's when you'll get some warrant coverage or some option grant or something on top of your investment.
Put an SPV together with other really influential women, right? We're on text with our founders. I mean, we're talking to them about packaging. We're talking to them about rollouts. We're talking to them about so many things. I mean, I don't know if that's something that all your clients do, but
well, you're the best one. But.
Thank you, Amanda. But it's not good enough to just be like, I'll post. It's like, no, we don't, that just doesn't do it anymore.
Yeah. Do you have one portfolio company that comes to mind that's taught you the most?
That's what? Sorry?
Taught you the most.
Oh, interesting.
That's a really interesting one.
I don't know. I learn a lot from every founder. Like, I think if you're paying attention, you can learn a lot from every founder.
I mean, Bumble for me, to be an early investor in Bumble was just, I learned everything from Whitney. I mean, I wouldn't be sitting here, honestly, without Whitney. She taught us how to move the needle for businesses. She taught us how to work with founders. She taught us how to think outside the box and to go with our gut. She taught us to trust our instincts. And I would have never had the confidence ever to do this. I mean, she really, her business is about championing women, and she really does champion women.
That's awesome.
We invest in this company called Grow Therapy, which is, again, is really trying to democratize access to mental health support for everybody, but it's essentially a three-sided marketplace between payers, providers, and patients. And what I learned from Jake Cooper, who's one of the most incredible founders we've ever backed, is believe what he says when he says it, because he was showing us this pro forma financial statement that blew my mind. I was like, there's no world in which you're getting to that sort of revenue growth and doing it profitably. And he said, yes, the reason we're going to make a big impact in this space is because we can make an independent therapist, an independent practitioner, essentially overnight with build their entire demand side. So all the patients immediately have access to book with these providers, which is incredible. But having the payers as buy-in was the ultimate unlock from a go-to-market perspective, a margin perspective. It's like three-sided marketplaces can be successful, particularly in categories where there's sort of an unlimited TAM as there is in behavioral health right now. So it's been a fun one where a lot of our clients are really passionate about mental health access, and so being able to be front and center and build brand awareness for that company has been tremendous.
Yeah, that's awesome.
Yeah, I would say at Corazon we invested in a company named Pretty Litter a bunch of years ago, 2017 I think. It was actually our first check out of our first institutional fund. And
you met him at one of these things, right?
yeah, and we met the founder,
Yeah.
Daniel, at a conference, and he raised one round. It was very small. You asked what we learned from. I learned how to build like a capital efficient business from it. Like he built a company that ended up selling to Mars for a bunch, and he did it without raising any more rounds of capital. And he every quarter would be like, we're profitable, we're profitable, we're profitable. And this was 2017, so like that was not in vogue. And
That's an outlier.
you know, he's a total outlier, and he built a company. By the time he sold, I don't remember exactly how many employees he had, but it might have been 15. Wow. And it was remarkable how capital efficient he was. And that, to me, that's like the prototype for how to build a consumer product business, like in this market. So I always kind of think about that template when we look at deals.
Yeah, that's a great one. So what do you see as the biggest opportunities in venture in the next 5 years, 10 years? You know, you've mentioned consumer product goods, but is there anything else that jumps out at you?
We're pretty aligned in the women's health space, aren't we,
Yeah,
Amanda?
absolutely. I think like digital health is a big one in women's health in
health, yeah.
particular. Like there's so much room to run there, whether it's focused on menopause or any other hormonal health issues. We've done something related to eating disorder management. We've done something in behavioral health for mental health support. Like I think that there's still so much room to run. Healthcare system is really broken, but spend there is bigger than it's ever been, which is wild. And so getting people better access to better providers, whether it's via a care navigation platform or a care delivery platform, like there's really interesting sort of margin and go-to-market for both of those. So we're spending a lot of time in consumer health.
I'm always in my world, in the fashion space, we're always trying to figure out ways, to limit returns. And Phil and I talk about this all the time. Montana, who's my partner here, we're always talking about why is live shopping working the way it's working in Asia, and we cannot figure it out here. And I think I hate to use the word bullish, but I'm really bullish that someone's gonna figure it out, or I'm always saying to Phil, what is it? Like, where is it? And someone I really respect was like, well, in Asia, live shopping is entertainment, and here it's commerce. And that's why it's not working. So I'm convinced that someone's gonna figure it out, and they're gonna figure it out big. And so I'm always looking for things like that, because that just selfishly helps my business.
Yeah.
But yeah.
I would probably hit on consumerization of healthcare just generally, which obviously applies to women's health and applies broadly. We're both Corazon and oversubscribed are an investor in a company called Future Health in the GLP-1 space. That company has grown really quickly, and it is very much a consumer healthcare product. Like for so many years, we didn't touch healthcare because it was its own isolated world, and it was very hard to operate within, and there were too many players, and figuring out who makes the purchasing decision somewhere was a very hard thing to do. I think because we're a consumer and consumer touching fund, the fact that healthcare is moving more consumer opens that up to us, and it is remarkable the impact you can have on someone's ultimate health by being able to access them directly and interact with them directly. And so
And doing more than just one thing.
Yeah.
Which is why I love, Corazon brought us Future Health. Future Health is doing it all, right? It's like they're bettering your life on many verticals.
Yeah. So I think that trend to me is very exciting.
Yeah, that's great. Yeah. We have a few minutes left. I want to do a few rapid fire questions.
Oh
Scary.
gosh.
It's gonna be great, guys. Don't worry.
Wait, one word? I can never do
You can do one sentence.
Okay.
I'll be flexible.
You have to do it in haiku.
Can you give us one prediction for the year? Could be about anything. Could be a Super Bowl prediction, venture.
Oh God. Well, I wanted the Bills to win, so I'm not upset about that. Oh God.
And venture is back. Is the
Venture
short answer.
never went away. I know
True.
it did, but did it really?
Well, we invest in sort of the emerging growth stage, so typically Series B and later. And late stage growth in particular the venture world, really had a tough time in 2022, 2023. People got really over their skis and putting money to work at the top of the market. And then all these companies were sitting on huge balance sheets. They didn't need to raise capital, so there weren't any deals happening. There were a bunch of crossover funds that had raised capital that were coming further and further downstream. But I think a lot of that has sort of settled out now. And I think that there's a really interesting crop of companies, particularly in vertical SaaS, that's powered by AI, that's moving fast from Series A to Series B. And I think you'll see sort of a speeding up of deal flow in that subsector of venture that was really slow for a couple of years. Like we did one deal in 2023, and normally we're doing 7 to 8.
Did you really?
One deal. It was like really, really challenging to sit on our hands, but in retrospect was the best decision we could have made because we passed on, by the way, great businesses, just wrong price.
Us too. I mean, you know, a little over 50% deployed on our fund one.
Yeah.
I mean, we are really.
It's good.
Yeah,
Patience.
listen, we have been very
But
patient.
that's what we said we would do.
But that's exactly what we said we would do.
That's what we said we would do.
And the market, I feel like the market, and we're, you know, like Amanda said, the later stage market took a very swift turn. The early stage market, not as much. It has come down, but I feel like it's settled in a very good spot. So like the price, what you can sort of get for what you are willing to pay right now is in a pretty good spot.
Well,
I think.
founders
So
are
I'm
also a little bit more realistic.
Exactly.
Like in the 21, our founders, their valuations, we were like, "Are you okay? You've no proof of concept. You have no. This is just an idea. You're not."
Asking the founder, "Are you okay?" is legendary.
Yeah.
I'm definitely known. I'm definitely.
Only Sarah can ask that.
Good.
Right.
No,
Just checking in. Is
yeah.
everything all right?
But public comps now support that question, which is to say,
Totally.
like, you were a little over your skis when you were asking for that valuation, and now, like, let's set the business up for success and use real revenue multiples or EBITDA multiples even would be better to value your company appropriately.
Yeah, one of the things, sorry, I know this is rapid fire, we're just giving you 5 minutes of
right.
content. One of the things I think founders lost track of is that the raising a round is not your end game. Like I think there was this like multi-year period where founders thought that was the only thing that mattered was like, what can I print in TechCrunch for my raise and my valuation or whatever. And like what they don't realize is it sets a hurdle for your business that if the market turns, you will never overcome. And that happened to a ton of companies. And so
Right, down rounds.
Yeah, down rounds or founders unwilling to take down rounds until it was too late and then whatever.
Structure got really dark.
And I think that has to reset itself. It has to work through the system where new founders come in and say, okay, I understand what my relative value and risk profile is. And I think that's what we're seeing now. And so I'm very bullish on where we go from here.
Cool. What is your biggest pitch red flag?
Oh gosh, I always say, I mean, it's not like I expect founders to come to the table with all the answers. Of course, it's a conversation, but when founders are not at least pretty clear about their roadmap, pretty clear about what they hope to deliver, I don't like a wishy-washy founder. It just doesn't make me feel safe. Maybe you guys disagree, but founders that flounder in a first meeting, I'm always just a little bit, I don't love that.
That's well said. I agree.
Yeah.
I could have said it a little better.
No,
You guys get what I mean.
When a founder makes it all about them, as opposed to about the market opportunity or the business, is like very scary to me because ultimately, like you can diligence the market all you want, you can diligence the product all you want, but at the end of the day, like most of the things that we're investing in are questions of execution because they're not that hard to build somewhere else, right? Like I'm not investing in deep tech where like they have that sort of information advantage. So if the founder makes it all about them as the individual, as the thing that's going to make this work, like I have a lot of questions.
Yeah, and for us too, we'll invest at any stage early. I mean, we'll pre-seed, pre-revenue, so we have to really have faith that the founder has a clear vision of what they're trying to do.
Totally.
Phil, what's your answer?
I like your answer.
Oh, he's piggybacking on mine.
I have nothing more to add. Charlie
never
Munger
done
would say.
that before.
Yeah,
Do you have one up-and-coming brand or celebrity/influencer that you think is going to be big?
Can I give a brand?
Yeah.
Because I love all of my clients equally.
Yes.
But one more than the other. We're investors in a company called Groons, which I'm a really big fan of. Yep. It's not Sarah's favorite thing, but it is
I've never tried it, okay? I've never tried it. I'm just, the gummy thing, I'm not there yet.
I get it. Athletic Greens I used to be a real big advocate for, and I think it's an amazing business, but not everybody wants to drink powder that tastes this way. And so they built basically the same sort of comprehensive daily nutrition, but in a green gummy bear format that's in single serve sachets. There's 8 green gummy bears. They taste delightful. And so if you're trying to fill nutrient gaps for whatever reason, it's a really elegant solution that tastes really good, and their customers are fanatic about them. So if you don't know about Grunes yet, you will soon.
I think instead of like thinking about a celebrity or an influencer, I think about a management team. You know, Skims does not work because only Kim. Skims works because of Kim, because it's incredible product, and because of the management team. You have Jens and Emma, who are operators times 1,000. So when those 3 things come together, you have a winner. So I think instead of thinking about the celebrity, you got to think about there's just so much more, and I think we now know that. It used to be, well, what celebrity is gonna, but I think we have to think sort of different now.
It's so interesting. So Alex Cooper sort of did that, right? Like Alex Cooper is a huge name. Call Her Daddy is an unbelievably successful podcast and now media empire, but she's building the Unwell Network with all of these other talent around her, which is to say that like she will be around forever. I think she's this generation's Oprah, but to have other talent that have different sub audiences that can all work together is a really interesting way to build that ecosystem.
Yeah, definitely. Phil, any thoughts?
In terms of brand, I would probably mention 2. One is Nara, which is, again, another portfolio company of both Corazon and Oversubscribed. It's an organic baby formula that was developed using whole milk, which the story of like how the baby formulas in the US got developed is a really interesting one that I wasn't aware of until we started really looking at the space. But a lot of them were created based on using skim milk or fat-free milk, and because of that, a bunch of additives have to be added back in to recreate the fat. We thought fat was an evil thing for a long time, and it's not evil. Anyway, they built this formula. It took them 6 years to get FDA approval. They got an FDA approval, and they pair the formula, which will come out this year, with an app that allows parents to track when their baby sleeps and eats and all these things. And so it's a hybrid of technology and product that I think is just a very interesting thing. Then the other one is Future Health, which I already mentioned.
Cool, that's awesome. Well, we're getting the wrap sign, but selfishly, I need to end by asking Sarah, can you give us any details on season 2 of Nobody Wants This? Anything you can share?
I think it's going to be a continuation of watching Noah and Joanne navigate life in their very different worlds.
Perfect. Well, thank you guys so much.
Thank you.
Thank you very much.
Thank you.
Thank you.